Welcome everybody. It's Wednesday and the Fed has raised the short-term borrowing rates by 3/4 of a point, 75 basis points. Everybody has been looking to see what the Fed's going to do about inflation and whether this will work. We're not quite sure. It has worked in the past, going back to the mid-80s, even further when Volcker was the chairman of the Fed. Raising prices is the way to actually stop inflation, according to many of the economists that we talk to. So we'll see what happens. But it's certainly painful out there if you're driving around a car, if you're looking to, I don't know, do anything when it has to do with food prices or has to do with gasoline, as I said, car prices. So much has gone up that we really, 10% over the last year. That's a big number. The CPI index came out again at 11% a couple of days ago. So, yeah, sorry for the pain. It's terrible, and I wish we could do something about it. But on the mortgage front, how does this affect mortgage rates? Well, NBC last night watching the news, and I noted that they made a mistake, and most people do. When the Fed raises rates, it doesn't necessarily mean that the mortgage interest rates are going to go up. They are not tied together. There is a symbiotic relationship, but not a direct relationship. And what that means simply is that if the Fed raises rates, the rates for your mortgage don't necessarily go up. The mortgage rates are tied directly to the 10-year bond. The 10-year bond is the gauge by which we all look at if we're looking to see whether rates are going to go up. The liquidity or the money we have available to lend to you is a little bit less today than it was yesterday because borrowing costs are going to suck the excess liquidity out of the market because those borrowing costs have just gone up by 75 basis points for things like business loans, car loans, college loans. These are the type of things that go up when the Fed raises their short-term borrowing to their member banks. Member banks, in turn, have to raise their particular rates. The mortgage interest rates are tied to the 10-year bond, which also happens to be going up or has gone up quite a bit, about 50 basis points over the last 2 or 3 days. Let's get right to the rates so you kind of understand a little bit more. Okay, the 30-year fixed rate is at 6.22, 6.22. The 15 is at 5.38. The FHA is at 5.62. The jumbo is at 5.15, and the 5/1 ARM is at 5.62. Okay, so all of that simply means that there's no correlation, but there's a relationship between what the Fed does and what your mortgage interest rate does. We've seen borrowing costs to get a mortgage really rise. And not only that, is if you have the Fed raising their rate, the amount of money available for mortgages gets really less, reduces less. So therefore, fighting for what is left in the mortgage pool is kind of why banks will tighten their particular restrictions. Not only that, is they're worried that the economy is going to put us into recession, i.e. killing the asset being houses, and make it less attractive to lend on mortgages because they're not quite sure what the value of the asset is or the value of the house is going to be. In that, let's talk about a couple of things that have happened. Redfin lays off 470 people, 8% of their workforce. Compass Real Estate, 450, 10% of their workforce. This tells us that because the rates have risen, product will be more available and less people will be buying. Therefore, all these real estate companies are laying people off. What else is in here? Okay, the U.S. home equity. This is a huge number, by the way. $27.8 trillion is the equity in homes, i.e. you have a mortgage for $100,000, you have $50,000 equity in the home, so your house is worth, $150,000. So across the country, we have $27.8 trillion in equity. Now, we've seen some equity in other assets or other places where people hold money. The stock market is reduced. Let's see, it says here by 12 point, where is it? $12 trillion. Okay, the losses or the loss in equity in the stock market has been $12 trillion. But the housing equity is $27.8 trillion. Really dwarfs what's going on in the stock market, doesn't it? Okay, so if you own a home, still feel good. Even if we have a recession and equity is reduced by 20%, there's still, way over 20 trillion in the U.S. equity available in your house. So that's a good thing. Let's see, home builders confidence 67, way down in May. And that is, of course, because interest rates on the mortgage industry and the mortgage rates have gone up. And because they go up, obviously, the confidence for builders, like a lot of other things, whether it's because they have a stock price that they have to maintain, they have gone away from building on spec. They only build on order, and orders are down if people can't afford it. If the grand pool of people who can buy new homes from KB or Pulte or Aspen or any number of these large home builders who build tract homes, if that particular aspect of home buying diminishes, well, the builders aren't going to build anymore. They learned their lesson in 2008. It's one of the reasons why we have such a shortage of homes on the market for sale, and probably will for a considerable amount of time. They're not going to build it and they will come. No, they have to come first. That's just the way it is. The ARM products are back. That's the adjustable rate mortgages. Why? Because they're about a point less than the 30-year fixed rate. So if you're looking for a short-term solution, ARMs have always been a good product, and I kind of like the ARMs. But you have to be educated and make sure that your particular loan officer is doing just that. Anyway, I'm Jeff Barton. Thanks very much. This is the Mortgage Minute. We'll see you next time.